Everyone thinks they know how gold works. War breaks out, uncertainty spikes, people panic, they run to gold, gold goes up. Simple, right? That's the narrative you hear on every financial news channel, every investing subreddit, every YouTube comment section. And honestly, it's not wrong, but it's also not the whole story. Because right now, with everything happening in the world, with tensions flaring and headlines screaming about conflict, gold is actually falling. And if you're sitting there confused, thinking, wait, this doesn't make sense, you're asking exactly the right question. You're just not going deep enough yet. See, most people operate at layer one. They see the headline, they connect two dots, and they think they understand the market. But markets don't reward surface level thinking. The real understanding lives one layer deeper. And today, that's exactly where we're going. So let's start at the beginning. War happens. What's the very first domino that falls? Oil. Every single time there's conflict in a major region, crude oil prices spike. Why? Because oil supply lines get disrupted, shipping routes become risky, and uncertainty around future supply sends traders into a frenzy. So, oil goes up. And when oil goes up, everything that depends on oil goes up with it. Transportation costs, manufacturing costs, food prices, energy bills, all of it starts climbing. You know what we call that? Inflation. Now here's where it gets interesting. When inflation starts rising, the Federal Reserve has one primary job: to bring it back down. And their main tool? Interest rates. They raise them. Sometimes aggressively. And the moment interest rates go up, something very specific happens in the minds of everyday investors. Your savings account starts paying more. Your money market fund starts paying more. Treasury bonds start paying more. Suddenly, sitting in cash or fixed income isn't just safe, it's actually profitable. So what do people do? They start selling gold and moving that money into interest-bearing assets. Demand for gold drops. Price follows. That's the first force working against gold, and most people miss it completely because they stopped at war equals uncertainty equals gold goes up. They never ask the next question, okay, but what does war actually do to the economy? And how does the Fed respond? But wait, there's a second force. When the Fed raises interest rates, global investors flock to the US dollar. Why? Because higher rates mean better returns on dollar-denominated assets. So demand for dollars goes up, and when the dollar strengthens, here's the thing you need to understand. Gold is priced in dollars, globally. So when the dollar gets stronger, what does that mean for someone in Germany or Japan or India trying to buy gold? It means gold just got more expensive for them in their local currency, even if the dollar price stayed the same. So international demand falls. Less demand, more downward pressure on price. That's the second force. And then, there's the third one. This is the one that catches people completely off guard, and honestly, it's probably the most powerful of the three. When war causes equity markets to tank, when crypto crashes alongside it, a lot of investors are suddenly sitting on margin calls, or they've got losses they need to cover. Or their portfolio is underwater and they need to free up cash fast. So what do they sell? They sell whatever they can sell quickly. And gold, physical gold, gold ETFs, is one of the most liquid assets in the world. It trades around the clock, globally, with massive volume. So in a panic, gold actually gets sold off because it's the easiest thing to liquidate. People aren't abandoning gold because they don't trust it. They're selling it because they need the cash right now, and gold is how they get it fastest. So you've got three completely separate forces all moving in the same direction, all at the same time. Interest rates rising, pulling money out of gold and into yield-bearing assets. A stronger dollar making gold more expensive internationally and crushing foreign demand, and forced selling from investors covering losses in other parts of their portfolio. Three forces, one direction, and gold goes down even as a war rages on. Now here's the important context. This doesn't mean gold is broken as an asset. It doesn't mean the gold is a safe haven thesis is wrong forever. What it means is that the relationship between gold and uncertainty is not a straight line. It's conditional. It depends on inflation, on Fed policy, on dollar strength, on what's happening in equities and crypto simultaneously. Gold can still be the right long-term store of value, but in the short term, The mechanics are messier and more complex than the headline suggests. This is the lesson that separates investors who actually understand markets from people who just pattern match off of news headlines. Layer 1 says war equals gold up. Layer 2 asks, what does war actually trigger in the macro environment? How does policy respond? And what does that do to the real demand for gold? The second question is harder. It takes more time, but it's the one that actually helps you make better decisions. Every time you see something in the market that doesn't match your gut instinct, that's not a signal to ignore it or explain it away. That's a signal to go one level deeper. Because almost always, the real answer is sitting right there, just underneath the surface, waiting for the person who's willing to ask one more question than everyone else. If this kind of thinking is something you want more of, understanding why markets do what they do, not just what they're doing, make sure you subscribe. Because that's exactly what this channel is built for. I'll see you in the next